One of the most confusing things about buying a home and getting a mortgage is going through the documents to clarify the details. How much do you have to pay a month? What is your interest rate? What are the total costs? And are there any hidden fees? This video will help bring clarity to the most important document you receive at the beginning of the process. When you are under contract to purchase a home, you'll receive a document from your loan officer called a loan estimate. In fact, every loan officer is legally required to send you a loan estimate within 3 days of being under contract. It's very important that you take the time to review this document, understand the details of the document, so that you will have clarity about what to expect going forward. So let's break down the entire loan estimate so you can understand all the important details about the mortgage loan you have requested. A loan estimate is a 3-page document that provides you with the most important information, including the estimated interest rate, monthly payment, and total closing cost for the loan. The loan estimate also gives you information about the estimated cost of taxes and insurance, and how the interest rate and payments may change in the future. In addition, the form indicates if the loan has special features that you will want to be aware of, like penalties for paying off the loan early. The form uses clear language and designed to help you better understand the terms of the mortgage loan you've applied for. All lenders are required to use the same standard loan estimate form. This makes it easier for you to compare mortgage loans so that you can choose the one right for you. When you receive a loan estimate, the lender has not yet approved or denied your loan application. The loan estimate shows you what the loan terms the lender expects to offer if you decide to move forward. Note, this is a loan estimate and not your final cost. So there are some things that your lender can tell you at the time of this estimate, and some things a lender won't be able to tell you until later in the process. As we walk through this document, I'll point out which of these costs will most likely be estimated. We will begin on page 1 of the top left corner. The first thing to do is check the spelling of your name. If there is even a minor misspelling, make sure the lender corrects it. Under that, check the property address. Make sure this property address is correct and the same address that is on the contract. The same goes with the sales price. Make sure that this is the exact price on the contract. Next, you'll want to review the terms on the top right corner. Check the loan term, the purpose, and the product. Make sure the information matches what you discussed with your lender. Under that, check to see if your rate is locked. If it is not locked, that means your rate is still subject to market conditions and can change at any time. Now moving to the top middle section of page 1, review the loan terms. Is the loan amount what you expected? Is the interest rate what you expected? And the monthly principal and interest payment is not your total payment. This is the principal, the amount you will borrow, plus the interest, the charge for lending you the money. While these are the main components of your mortgage payment, your total monthly payment will typically be more than this due to taxes and insurance. More on this below. Check to see if there is a prepayment penalty. If yes, then you will see the penalty detailed out if you pay your loan off early. Most loans do not have a prepayment penalty. Is there a balloon payment? A balloon payment is a larger than usual one-time payment at the end of the loan term. If yes, then your payments may be lower in the years before the balloon payment comes due, but you could owe a big amount at the end of the loan. Most loans do not have a balloon payment. Next section is the projected payments section in the middle of page 1. This section will break down your total estimated monthly payment. Principal and interest. This should match the number above in the loan term section. And if you have a locked rate and on a fixed term, this part of your mortgage payment will never change. Mortgage insurance. Typically, borrowers making a down payment of less than 20% of the purchase price of the home will need to pay for mortgage insurance, except for VA loans. Mortgage insurance lowers the risk to the lender of making the loan to you, so you can qualify for a loan that you might not otherwise be able to. Check out our YouTube page for more detailed information on mortgage insurance. Estimated escrow. This is the account that pays property-related expenses such as property taxes and home insurance. If your loan doesn't include an escrow account, you will have to plan to pay these large expenses yourself. To determine the amount, the lender takes the annual home insurance premium and the annual property taxes, then divides by 12. For example, if your insurance is $2,000 a year and your taxes are $2,000 a year, your monthly escrow payment will be $4,000 divided by 12, which equals $333. This part of your monthly payment will change annually as your insurance and taxes change. Estimated total monthly payment. This is the total payment you can expect to make to your mortgage company each month. If your rate is locked, the principal and interest won't change. The mortgage insurance should not change unless the terms of your loan changes. The escrow may change if you have not already sent your lender a home insurance quote or the lender has not received the actual taxes on the property. If you are not expecting this monthly payment, make sure to discuss with your lender. There may be ways to get your payment more in line with your expectations. Estimated taxes, insurance, and assessments. If you're purchasing a home with HOA dues, these dues will be expressed as a monthly cost here. HOA dues are not part of your monthly payment. Now, the last section on page 1 is the cost at closing section. Estimated closing costs are the upfront cost charged to get your loan and transfer ownership. They are part of what you have to pay at closing. We will break these down on page 2. Estimate cash to close is the amount you will have to pay at closing in addition to any money you have already paid. This payment is usually made by cashier's check or wire transfer, and these are the funds the lender will have to source prior to your loan being fully approved. Now let's move on to page 2. Let's start with section A. These are the upfront fees charged by your lender and are an important part of the cost of your loan. If you have points in this section, these are fees you pay to the lender in exchange for a reduced interest rate. Make sure that you discuss with your lender if it's worth paying points or not. Check out our YouTube page on if you should pay points or not. Other common origination charges include application fees, origination fees, underwriting fees, processing fees, verification fees, and rate lock fees. On to Section B. Section B lists out third-party services that are required by your lender in order to get a loan. These settlement services provider fees include appraisal fees, credit report fees, and flood determination fees. Some fees in this section may depend on the kind of loan you have. For example, if you have an FHA, VA, or USDA loan, the upfront mortgage insurance fee or funding fee will appear in this section. These fees are usually sent by the government program and not by the lender. Also, if you have a conventional loan with private mortgage insurance, any upfront mortgage insurance premium would also be listed in this section. Section C breaks down services that are required by the lender, but you can shop for these services separately. Services include such items as pest inspections, surveys, attorney, and title services. So Section D is a total of Section A, B, and C. The right side are other costs. These are costs associated with the real estate transaction, transferring the property to you, and the cost associated with owning your home. Section E are taxes and other government fees. Recording fees charged by the state and local agencies for registering a property's transfer of ownership. Transfer tax is a one-time fee imposed by a state or local jurisdiction upon the transfer of real property. Now, Section F are prepaids. Prepaid interest is a per-day interest amount from the closing date to the end of the month. Home insurance premium is paid up front and is set by your insurance company, not the lender. You get to choose your home insurance company. Usually, you will pay 12 months of home insurance premium as part of your cash to close. If your actual home insurance premium is different than the lender estimate, your monthly payment and cash to close will also be different than the estimates on page 1. Section G, initial escrow payment at closing. The initial escrow payment is the money deposited with the lender which will be used to pay future home insurance, and property taxes. This is the amount to start your escrow account so that when premiums are due next year, the account will have enough funds to pay these bills. Section H, Other. Typically, you will see owner's title policy in this section. This is an optional fee and not required. Owner's title insurance provides protection to the homeowner if someone sues and says they have a claim against the home from before the homeowner purchased it. Now, the lender's title insurance protects the amount of the lender's loan. Owner's title insurance protects the owner's total financial investment. And Section I is just a total of E, F, G, and H. Section J is your total closing cost and should match the estimated closing cost on page 1. Also, if there are any lender credits, these will be listed here in Section J. Now let's review the Calculating Cash to Close section. Your estimated cash to close should match with page 1. This is the estimated amount of money you will have to bring to closing. This section shows how the estimated cash to close was calculated. Your estimated cash to close includes your down payment and your closing cost, minus any deposit you've already paid to the seller and any amounts the seller has agreed to pay towards your closing cost, like seller credits, and then any other adjustments. If the estimated cash to close isn't what you're expecting, ask the lender to explain why. You will typically need a cashier's check or wire transfer for this amount at closing. The lender you choose will also need to document the source of the funds you bring to closing. Finally, page 3. Page 3 is made up of good information to know and is also where you sign the document. Now, the top section is information about the lender. Right under that is the comparison section, which offers several useful calculations to compare the cost of the loan offer. You can see how much principal you will have to pay in the first 5 years of the loan. You can also see your APR. APR is one measure of your loan cost. This is not your interest rate. APR reflects the mortgage interest rate plus other charges. It is a broader measure of the cost of borrowing money than the interest rate. The APR reflects your rate, plus your points, plus lender fees, and any other charges you pay to get that loan. The total interest percentage is calculated by adding up all of the scheduled interest payments, then dividing the total by the loan amount to get a percentage. Again, it is for comparison purposes only and is not the same as your interest rate or your APR. Note, the TIP does not include upfront fees. So one loan may have a lower TIP but higher fees than another loan. Other considerations. You're notified in this section that the lender may order an appraisal and charge you for that appraisal. You will receive a copy of that appraisal. Some loans are assumable, and you may be able to sell the property and allow the new owner to assume this loan on the original terms. FHA loans and VA loans are typically assumable. Contact your lender to find out more details. Late payment terms are outlined here, and if the lender is going to transfer the servicing or keep the servicing is outlined here. If the lender keeps the servicing, this means they will handle the loan on a day-to-day basis. For example, accepting payments and answering questions. Finally, confirming receipt. By signing, you are confirming that you have received the form. You don't have to accept the loan at the time of the loan estimate. Your final acceptance of the loan happens at loan closing. Once again, it is critical for you to understand all of the details in your loan estimate. The more comfortable you are with your numbers, the less stressful it will be for you when you purchase your house. And if you have any questions while you're going through this, make sure you talk to your loan officer. A good loan officer will sit down and take the time to answer any questions that this video hasn't explained. Hey, if you like this video and it was helpful, and you also want to keep abreast of what's going on in the mortgage industry, learn more about products and programs, the process of buying a home, please like and subscribe to our YouTube channel.